Good morning, everyone. Thank you for joining this panel discussion. My name is Hiromichi Mizuno. I'm a senior advisor to Milken Institute. I run the Japanese government pension fund until 2020, and then ever since I've been trying to promote the global sustainable development of the capital market. And all these people I have here as the panelists today is playing a very important role shaping the future of the capital market or the financial market. So I'm really myself thrilled to hear from all these distinguished panelists. I think the theme given by the Milken is that we wanted to discuss what could impact the future of the capital market, and then I expect the majority of the participants probably in some ways involved in the financial capital market. But at the same time, through our prep calls, we think like there's a lot of change in the social value, particularly given by the generational shift of the wealth. Will make reshape what we are doing our industry and what we are doing as a whole as the global economy. So I just want to start from the hearing from each panelist. Maybe this way. First of all, sometimes just introducing yourself, and also maybe pick one that what you think is going to make the biggest impact in shaping our future economy or future capital market. So can I start with Andy?
You bet. Yeah. You bet. Good morning, everyone. It's great to be here. And of course, you've set a broad agenda for this panel. It's hard to pick one. But if I was going to think about one topic that is perhaps underappreciated, it's a topic that's very core to the world of wealth management. When we think about the wealth management industry, a truism is demographics are destiny in wealth management. It drives client needs and the way we serve them. And I think that one of the mega trends that is going to drive the business opportunities that face us all is longevity and the longevity revolution. It's amazing to me how much that underlies both macro and micro trends affecting our business, but it doesn't garner the same attention that so many of the mega trends do. When I talk about longevity, this is obviously is driven by the fact that for the whole history of human civilization, average lifespans were probably in the low 20s. We saw this explosion of longevity in the 20th century, progress continuing. And today, on a micro level, the life course of our clients and all of us is completely different. No longer can we plan for a life that's 60 or 70 or 80 years. We're planning for lifespan over 100 years. And with that much longer to live and that much more to do, the way we're spending our life in different phases is completely different. And of course, when we take these changes and we look at them across countries, regions, it's driving macro flows, the need to manage very different risks over time. And, I would posit almost every industry, if it isn't already, will have to step up to the way consumer tastes are changing, kind of given demographic changes and changes in longevity. So we could go on about it. That sets the table. Hopefully we can come back to that as a discussion.
Thank you, Andy. So next, Saira.
Thank you. Hi, everyone. Good morning. I'm Saira Malik, Chief Investment Officer for Nuveen. Nuveen has $1.3 trillion in assets under management. I'm fortunate to also be chairperson of our Global Investment Committee. I manage a multi-billion-dollar equity strategy, and I'm also listed portfolio manager on about $200 billion of our equity assets under management. When I think of the next generation, I think of the 80+ trillion in wealth that will be transferring from generation to generation. And when I think of that, I think of the need to improve financial literacy, because access to information and education is going to be very important. So I'm going to start by asking the audience a question. Raise your hand if your high school required you to take or offered a financial course on the markets. I can't the lights, but I see very few hands. So the good news is Today, over 20 states require financial courses to be taught in high schools. And I also talked about access to information. The next generation is accessing financial information differently than the baby boomers. So baby boomers get about 3% of their financial information from social media, but 1/3 of millennials and 1/3 of Gen X uses social media to gather their financial information. So we're changing the ways in the next generation and the money that they're going to inherit and how they're thinking about it. I started on financial literacy, and it's a very passionate topic for me because I grew up not too far from here in Stockton, California. My public high school did not offer any classes on finance. When I was a senior in high school and I went to my guidance counselor to ask him what I should do next, his advice to me was, you shouldn't go to a four-year college because he didn't think I would make it through. So while they weren't offering free finance classes, they were offering free bad advice. Now, I didn't listen, and I went to a school not too far from here, Cal Poly San Luis Obispo. My mother was an immigrant from Pakistan and a medical doctor, but her real passion was the stock market. So how I got my initial financial literacy was self-taught by my mom. Her enthusiasm for the markets rubbed off on me. And when I was a junior at Cal Poly, I got my Series 7 and 63 licenses and started working as a part-time stockbroker. And I started publishing my own stock market newsletter, which I would send to clients with my stock picks. Now, I didn't think anybody would really pay for my stock market newsletter because I was 19, but what I asked them was if they liked any of my stocks, would they trade them through me as their broker? And then I made a little money on the side by doing that. And that is how I got my start onto Wall Street. But this is why I go back to the key of improving financial literacy from an early age, because it can help close the wealth gap. It can help all of these younger generations inheriting money learn more about finance. And it can really widen the playing field in terms of where Wall Street hires from schools so we can get more diverse people and more people with diverse educational backgrounds into our industry.
Thanks, Saira. I think I'm also passionate about the financial education, but sometimes better education is worse than no education. So we just need to make sure that the younger generation get the right of the education, which we definitely want to discuss what they should be learning. Because I'm really concerned about the social media information gathering, probably like bifurcating the younger people investment strategy into chasing meme or like just investing just into the index, not to think. So I think that we will definitely revisit that the importance of education and how they're going to possibly reshape the future participant of the capital market in a better and more informed way. So Jonathan, can I ask you the same question and just introduce yourself and just pick up one particular topic so that we can follow up?
Good morning, everybody. I'm Jonathan Goldstein. I'm the CEO of Cain International. I grew up in London, and similar to Saira's story, I got 5 rejections for university. My school determined that I was not good enough to take a law degree at the age of 18, and it was my parents' determination to send me to grammar colleges during that time that enabled me to start on the course, and I was the first member of my family ever to go to university. My grandparents were ultimately immigrants into the UK. I think the point that I'd just like to focus on is that when we look over the last 15, 16 years since the ending of since the global financial crisis, we can't but avoid the consequence or the conclusion that over that period in time, the disparity of wealth between rich and poor has grown exponentially. It's a crime to all of us that within a couple of miles of Beverly Hills or within the center of London, the amount of homelessness that we see around town. Now, from a capital markets perspective, you can take positives from the rich getting richer. And as the developer of the land next door here and building an Aman hotel and Aman residences, we've in some senses been the beneficiaries of that. And when you look at the luxury markets, even since the pandemic, the S&P index has outperformed by 40%. The LVMH share price has probably doubled during that time. You look at the way millennials and the Gen Zs want to spend their money and enjoy experiences, their gravitation towards quieter, more subtle brands like Loro Piana or Hermes as opposed to the louder, more bolshy brands. And we've seen some of the financial performances of those brands really suffer in the course of the last 6 to 12 months. And we've obviously, as investors in the Aman Hotel Group, have obviously benefited from that trend as well. But I think we would be mistaken or blind as investors to assume that this disparity is not going to come at a long-term cost to many of us in society unless we address it and understand that as part of the social fabric, our contract with society, that we have to ensure that there is a level playing field out there and to ensure that there is equal opportunity. We have been the huge beneficiaries of that equal opportunity. But I am concerned that the disparity that's occurred over that period of time has led to a widening and is leading to a seismic shift within society that we're seeing within our political lives and we're seeing also in our society lives. And I think that whilst we might be, as investors, and I am as an investor, benefiting from that polarization, I don't do it blind to the fact that we have to ensure that there's some level of equality and leveling up in society, which I think if it doesn't occur, will end up costing us in the capital markets big time in the short to medium term.
Thank you. So, Raph?
Thanks. Morning, everyone. So I'm the CEO of the Future Fund, which is the Australian Government Sovereign Wealth Fund. And one of the things that means is I don't have to raise money, I don't have clients, I don't have a regulator, and I just think about investing. What a luxury. And so it's great to come to a place like this and talk about these sort of issues. So today we're talking about the generational change and what that means. And it's true, I think, that demographics is destiny. It's one of the few things we can predict with certainty. But it's not true that the generations that are coming up will do the things we think they should do or what we tell them. And it's important, I think, to listen to them and to understand things from their point of view because they're not going to listen to us, that's for sure. And so what we've already talked about it, is a pretty big generation in the baby boomers ageing, retiring. They're the richest generation in history. Are they so clever? No, they're quite lucky, I think, because they were born at a time where there was an emerging middle class, there was globalisation, we were learning how to use leverage to bring forward growth from the future and invest in today, and they benefited from the rise in asset values through that period. And I think it would be foolish to think that the wealth transfer that ultimately will happen in an unfettered and uninterrupted way. Because our younger generations won't accept it. Today, the Gen Z and Millennial cohort, which is becoming the marginal voter in most Western democracies, has a stronger voice, and they're not happy. There's high inflation, their earning power is being eroded, they're not as wealthy as their parents by and large. They don't look forward and see the light on the hill that previous generations saw, and so they want bigger, more intrusive government. They want stronger institutions that they can rely upon. They believe less in democracy, and so I think we're very likely to see a push towards a wealth redistribution, whether it's through inheritance taxes, wealth taxes, income taxes, capital gains taxes, all of those, and with that money being put towards other types of social causes, equality programs and so forth. So I think for those of us active in markets who invest, both here and globally, we need to think about what that means, what does a bigger, more intrusive government mean, and how will it impact markets?
Raph, you actually brought in very interesting perspective about the wealth transfer, like, the 80-some trillion dollars transfer from the baby boomer to their heirs. We kind of like take it for granted. And then, but at the same time, as Andy, you mentioned, that we have, longevity, the issue that the people tend to live longer. So the transfer, 20 years ago, we expected it to happen much earlier, but maybe not happening as early as we expected. But this is something we wanted to dig a little bit further, like, whether that wealth transfer is really happening at the scale that will impact the way the capital market behave, or all those like the social distribution mechanism Ralph mentioned, that's actually not effectively really happening? Or like, how do you guys see that this wealth transfer things is going to impact the markets? So anyone want to pick up? Maybe Andy, you want to start?
I'm happy to jump in, and maybe for the sake of a lively panel,
Yeah,
we can
sure.
maybe
That's
pick up on
important.
some things that each other have talked about. But I've got a bit of a different perspective on what's happening around the world right now. I mean, I think we are at a miraculous time in human history if you look at it in the broadest sense. We've activated market economics in regions of the world that haven't experienced it. We're seeing unprecedented levels of wealth creation. The distance from the top to the bottom may be further, as has been correctly pointed out, but overall, the increase in living standards which has happened, the decline in poverty rates, the dramatic improvement in infant mortality rates, speak to an overall wellness of being around the world that I think we could have only dreamed of 100 years ago. I do think, to the last point that was made, one of the great risks we have is that policy responses will cause the core wealth creation engine to be knocked off track, while trying with the very noble aim to try to see as many people experience good outcomes as possible. But I really in terms of thinking about powerful positive megatrends, $100 trillion of forecasted wealth creation over the next decade ahead, that is not going to be narrowly focused. The forecast is 2 billion people will join the middle class around the world. So this is an amazing moment, and I think the essence of that in terms of what free markets have created is something we have to hold very tightly to.
When I think of the capital markets landscape for the next generations, I look at three things: portfolio diversification, interest rates, and inflation. So just starting with what for many of our careers, the 10+ years of easy money, low inflation, that's behind us. If you look at interest rates and inflation pre the global financial crisis, just starting with rates, the federal funds rate going back about 50 years pre the GFC was close to 6%. From the sort of post the GFC till a little bit through the pandemic, Fed funds rates of below 1%. I think the normal was the pre-GFC period. So next generations have to think about, how do I invest in a period of structurally higher inflation and interest rates? I think that leads to portfolio construction. Many investors have had their portfolios in a 60-40 split, 60% equities, 40% fixed income. That gives you the correlation that you need and the diversification, and that's how you kind of keep your portfolio going forward. We've learned in 2022 that equities and fixed income can be highly correlated to the downside. So I think the 60-40 evolves to the 50-30-20. 50% equities, 30% fixed income, 20% alternatives. I think younger generations are going to incorporate more alternatives into their portfolios, from infrastructure to private credit to private equity to farmland to real estate. All of these asset classes can help reduce your correlations and increase your diversification in portfolios. So I think that's going to impact the capital markets going forward.
Anyone else? No. But I have one question. It's like, money will be inherited by the younger generation, and then Saira, you touched upon the education, financial literacy, and then Japan is known for everybody put all their assets in a bank deposit, and the current administration working really hard to educate and encourage the young people to put into the tax-exempt investment scheme. And then also, when I grew up, a lot of people saying like, the American people do more equity investment because they are more financially educated. But when I moved to the US, I just realized there's no real financial education here either. All right, so it's just basically that people take it for granted. Investing into the stock and the participant in the economic growth is a good thing for their wealth creation. So my concern is the younger generation, although I think they are statistically wealthier because a lot of parents leave some money for their parents and children, and then also on the surface or nominal amount of their earning is much more than we used to earn when I was younger, but they feel poor. And then that kind of the sentiment, I just wanted to ask your opinion, like why that sentiment is happening and whether that kind of sentiment will affect how much they invest, because I really don't believe that their textbook can really tell that the young generation to invest, because they need to feel confident into the stock market and the economic growth to participate in it. So, what do you think? Like the younger generation will continue this, their parents' investment, the behavior, or are you gonna see a totally different investment, their attitude?
Well, I think first I'll start with, for many of us, for many people throughout their careers, or for the majority of our careers, we watched the US stock market outperform the rest of the world, and during the 2010s go up low double digits. So we got very used to, if you invest in US stocks, you're going to make a lot more money than you used to in the past. That's why I am concerned higher interest rates and higher inflation should lead to lower equity market returns. But I would say don't bet against the US. Our lead in technology versus the rest of the world, I think, does cause the US to be a very strong performing market going forward. But maybe I'll talk about some of the things that our studies and studies that we've seen have shown that the younger generation does care about. They care about 3 things I'll talk about: impact, diversity, and also what are their goals. So starting with impact, I describe the younger generations as investing with their head and their hearts. And what I mean by investing with your head is the typical diversification in your portfolio, asset allocation. What's the economy going to do? Is inflation here to stay? I think the answer is yes, more than it used to be in the past. Goals, what does the younger generation have? The younger generation is looking to be more engaged in their portfolios. They're looking for more diversification into alternatives. They're getting multiple sources of information about their portfolios, from social media to multiple financial advisors. They want more use of technology in their portfolios. How is AI going to play into it? I think that's important. And then I mentioned diversity. Younger populations, by definition, are more diverse. Just looking at the U.S. right now, the largest minority cohort in the U.S. is Hispanics and Latinos, and less than 1/3 of them own a financial product or account. So why is that? I think because when they're looking to own an account, they want to build bonds and trust with people who look like them. So I think our workforce on Wall Street needs to become more diverse to meet the needs of a more diverse population.
I totally agree. I think if we go back to sort of what are the trends underlying, how will that impact financial markets? So really, I think the point here is we've got to rethink how capital markets create an opportunity to back a growing company or lend to a company that needs that money to fund their operations, or even a government. What's important to the people who are the ultimate savers? And they're asking different questions, and they'll demand different outcomes. And so I think it's incumbent of those of us who work in the industry to understand that. And it's not just building products, right? That's really just reslicing the existing ecosystem. It's actually building new companies and new ways of thinking. And I think in my experience anyway of younger people, that's what they expect, right? It's not an issue, like one of the topics was, what's happening with ESG, is that important? It's not really an issue of ESG, it's really an issue of, I want my savings to do good in the world.
And I think that was one of the points I was trying to touch on at the beginning. I think that the younger generation are migrating towards those companies, those brands, those operations, which they think promote a more sustainable message than those that don't. And I think the other point I think about financial literacy, whilst I think we can all question the level of education within schools and colleges, the accessibility of the financial markets to the younger generation today compared to when we grew up is just exponentially different. I listen to my own children talking about their holdings within various, with their own income within various, platform, slicing and dicing, as you would call it. And that's an accessibility and understanding that most people did not have back in the 80s and 90s. So I think with every yin, there's a yang. I do think there is significantly greater opportunity for people to access markets and understand it. But I do agree with you that I think that as time goes on, we need to ensure that we develop products and opportunities that meet the needs of the next generation. because we certainly don't think like them.
Yeah, I mean, younger generations, you mentioned sustainability. I talked about investing with their head and their heart. They are interested in terms of what is the impact and purpose of my portfolio, a lot more so than, older generations are still thinking in the more traditional investment ways of the diversification and asset allocation, but younger tend to think of both.
That's exactly the point, like say, financial education. Like I've been really trying to be active in the changing the MBA education, the CFA education, where they really still don't get anything to do with sustainability in their curriculum. So I think the more financial education we need to try to bring in, we tend to teach the younger generation the very classic investment theory. But the younger people probably not going to be driven by that because they are much better informed than we used to be. So can we trust that the younger generation will those like ESG and sustainability into their real investment decision? Because that's another thing our generation came up with the idea of the sustainable investment. Our generation is pushing it back too. So we always say like a younger generation is different. And but can we believe in that, or like that we continuously teaching them to invest in the way we invested?
I think it's easy to fall into a trap to assume that the younger generation don't think in their own way, in innovative ways, in the same way that I hope we did X number of years ago. So I think that with the wealth of information available to them at this point in time, I think that we, I don't think it's for us to trust. I think we can just assume that human nature leads to a level of diversity of thought and original thought which will produce different outcomes. I mean, I think the big challenge for all of us and for the next generation is the impact on AI on most of these situations, and how does that impact the capital markets? How does that impact many businesses? And how do we ensure and how do we try and provide that is a force for good and not the dangerous force that I'm concerned that AI can be in so many areas?
So I think
maybe
let's not forget,
Andy next.
We're not just talking about savers here when we talk about young people, we're also talking about voters, right? And so I think there's a channel here where governments and regulators express the views of their populations on companies, whether or not the people who are expressing those views are owners of those companies. So for example, right now, right around the world, there's a lot of effort and energy going into carbon reporting. That's going to be a consistent framework across the world. Natural capital, biodiversity reporting is coming quickly. And that's an expression from voters to their governments about what's important. But that transparency will change not just how people invest, but how companies behave.
Andy?
And I feel very strongly, and I think in line with the rest of the panel, it's a certainty that next generation will have additional dimensions to their investment decision making. It is no longer just risk and reward, it's risk, reward, and then another axis that is driven by broader views of the world, preferences, and the like. I think it's driven by a couple things. One, the younger generation has learned, hey, I can vote with my pocketbook as a consumer, and so every activity that the younger generation has as a consumer carries some meaning with it that I don't think prior generations had. They view consumer products as reflecting something about themselves to the broader world. So it's not much of a leap at all to think that that's going to carry over to their investment activity. And then you combine that with the fact that one of the things I think we're in the middle of, which when you stop and consider it, is radically different than our parents' or grandparents' generation, is people today are so open about money. I mean, the World War II generation, you would talk about sex and religion before you would talk about money in polite company. And so today, hey, the social media and social sharing encompasses all topics, including money. So therefore, the way you're investing and your views on investing hey, you're quite happy to have that be a signal that you're sending out to the broader world. So I think that's very bedrock change in the way the markets work. And I think that any investment firm that if you're holding that at bay, you're on the wrong side of this mega trend for sure. And that is not a political view. That's a view of how do we best understand the decision-making process of our clients? Because for everyone who prioritizes climate, sustainability, and social topics of the left, someone else is thinking about Christian value portfolios and the way to express, their political views through the way they consume and invest.
Do you really hear from your younger the clients or like the customer base is asking for better or like a new product?
Oh, 100% of the time. And it's probably most clear at Citi in our wealth business, we serve 1,800 family offices around the world. When generational change happens in a family, the nature of the conversation we're having with the family office shifts almost immediately. It is as stark, the matriarch and the patriarch are in the room, the next generation comes to the table, and the conversation is on very different ground. Perhaps not immediately in a way that changes an actual decision, but the dialogue has shifted, and then over time, as the role of the generations change, portfolio decisions are going to move in new directions as well. It's very, very clear.
Very clear. Sarah? Yeah.
I might add, you mentioned at the beginning of your comments about the CFA and the MBA and what, is there still going to be value in that? And that brings me to think about something I stand very strongly for, which is educational diversity, which is encouraging Wall Street to hire from a wider array of schools. Now, I actually have my CFA and my master's degree, partly because when I graduated from Cal Poly with my Series 7 and 63 license and ready to show everybody my newsletter I'd been printing on my dot matrix printer, I applied to 20 Wall Street firms. I got rejected from all of them, and I didn't even get an interview at a single one. So I was like, okay, I better keep moving along here, and I got my master's, I got my CFA, and I eventually did get a job at JP Morgan Asset Management. But I think Wall Street needs to start looking, and I think education is shifting, at a wider array of schools. State schools, other schools where students, go for a wide variety of reasons, have very talented students. And why is this important as an investor? Because oftentimes, the strongest returns are made when you're going against the grain, and you're thinking outside of consensus. And bringing people in who are taught from a different lens of professors and a different educational background, socioeconomic background, I think can only bring more of that non-consensus into the room and help our returns.
So I think what we teach is very backward-looking, right? So we tend to teach people, here is what's happened in the past, here is what's worked in the past, and then people just automatically assume those trends will continue. And I think what we're all saying is, no, that's not very likely. So we actually need people, I agree, that can think, and that can think from first principles and can think about what will the world look like in the future. And we haven't really touched on it. We've touched on some of the policy trends, but obviously there's a lot of discussion going on at this conference about the geopolitical trends as well. We're expecting much more conflict in the world. Some of the assumptions we've made about free flow of capital, what globalised efficient supply chains are, whether governments should direct capital flow or not, they're changing rapidly. We're starting to look at a world much more like the 1930s than any period since. And I don't think we teach that in finance school or in MBAs, and I think we need to.
I was going to say a similar thing to Raph. I mean, we can talk about diversity, we can talk about ESG, we can talk about sustainable investing, but I think one of the issues that is difficult for the next generation to understand inherently is the geopolitical risk that maybe we see at our age. And I have to say, as a Londoner coming to America, the more narrative I hear of America opting out of the world and opting out of that debate, opting out of that process, concerns me because I think it heightens the geopolitical risk. I mean, we're almost 80 years since the end of the Second World War, and other than effectively localized conflicts, which obviously have been tragic in their own, and we've got there's two going on at the moment in the world, which we're not going to debate those, but which have their own dreadful stories behind them. But I think unless we able to bring the world together in one form or other and understand that there is a way to move forward, I think that we are really underpricing the level of geopolitical risk that not only the next generation, but we are carrying as a generation. Because I don't think it's too far. I mean, Rafa, you equated it to the 1930s in some ways, and I think we can all see those trends emerging. And the polarized nature of not just American society, but of the world today certainly makes me very concerned about the near-term impact that can have. And I'm less worried about its impact on capital markets than I am about the human race.
How should we address the issue, saying, we grew up in the thinking the asset manager, asset owner, we have our own fiduciary duty to make sure that our beneficiary get the proper return. And then sometimes the people use the fiduciary duty to kind of prevent the CEO, CIO to think about taking care of all those social and environmental impact of the portfolio. But as Andy mentioned, younger generations wanted to take that dimension into their investment decision, right? But at the moment, the capital market, those people are not majority, so it's not really, they are pushing the market to price those risks or opportunities in the way they wish. So there's always a gap in how the market is behaving today, and then the CEO have to navigate what's happening today in the market, but also as our industry probably wanted to take care of a future generation and wanted to bring those dimensions into the investment decision. So, I'm just giving an open question, but how we will navigate, all of our panelists have taken an important role in a different part of our industry, but, what do you think? Raphael, you probably, they're really dealing with the fiduciary duty as a part of your business, and then how you bridge that gap.
Yeah. So I think that's a really important question that gets asked a lot. Personally, I don't see a conflict. I think it's all about your time horizon. If you're acting in a way, if you invest in a company that's acting in a way that is damaging the world or damaging some part of society, ultimately they won't be allowed to continue to do that. And we're seeing that all over the place at the moment. And so if you take a longer time horizon, there is no conflict. And I think there are parts of the world, not unfortunately the US, but if we take Australia, for example, where I'm from, where the institutionalisation of capital in the superannuation system, which is acting on behalf of individual savers at the end of the day, is organising itself in a way to exert influence on companies in quite a positive way, I think, in terms of their long-run value creation and return focus at the expense of short-run opportunism. And I think that's actually good for the society. It's also good for the sustainability of the system, and I expect it will flow to other parts of the world. I think one of the issues when you have a big wealth inequality is that the owners of the companies are very concentrated, often much older, and therefore might have a different time horizon than the broad population.
I might add that ESG metrics are important to the investment process, especially when they're financially material to the company. So when you think of environmental and an energy company, which may have stranded or low-quality polluting assets, that could be impactful to the stock price and the profit margins. As an investor, we're always going to be considering that. Governance of companies, which may put the company at risk because of poor quality management by the board or things happening in the company. That could be material to the stock price. Social issues, even in many sectors, they're much more heightened than in other sectors, and employees can care. What does my company socially stand for? All of that can have to do with your ability to hire, retain, again, financially material to the stock price, because in the end, we're focusing on generating the strongest returns that we can for clients, and all of these can be important, more or less so across sectors, and that's how we've always thought about it from an investment point of view.
Andy, how do you just explain to those younger clients that about that gap? I mean, they're probably not going to get the as much return as they could have made by just simply investing into the traditional index.
Well, for I wouldn't be too quick to say that. I mean, it's there's a range of companies, range of investments that reflect broader social values in different ways. We can think of lots of consumer-oriented companies which have distinguished themselves because of their the way their brand links to sustainability, and they've been wildly successful. As broadly as I read the discussions we have with clients, they're generally, while these conversations, and particularly conversations with the next generation, are now including a broader set of considerations beyond, simple risk and return. If you put a negative 200 basis points of return kind of into the discussion, that's not acceptable either. They push back and say, you can do better than that. You mean you can't help me rebalance my broad equity market exposure to minimize the exposure to companies I feel badly about for whatever my reasons are, and maximize the exposure to companies that I feel good about? And I think the answer to that pushback is, hey, that's actually something we can do much better today with technology than we could previously. But I mean, to your direct question, if forced that there's an inevitable trade-off of return, they're not going to want that trade-off. They're going to come back and they're going to ask a financial institution to do a better and more careful job and try to get them as close as they can be to their return expectations while still operating in a way that's consistent with, with their broader view of the world, if that makes sense.
I see. Anything additional to add to this? But I think the several interesting questions coming through the iPad, and it's I'm not going to mention all of these, but which I found interesting. Like sounds like some of the kind of probably like a students is asking like, what about the students asking their endowment to divest from like some industry or some country, and those kind of things are becoming very, very vocal. And then when I was running a GPEV, I got pushed by a lot of the young students saying like, why don't you divest from this industry? That's the one quite typical area of the conflict between what's happening in the market today and what they think we tried. They wanted to shape the future world.
I don't think it's obviously not a new trend. Okay, I mean I grew up in the UK where the anti-apartheid movement did very much chose certain companies which they saw trading with South Africa during that time, and sought boycotts of those companies, and sought investor boycotts. I think the difference today is the hostility and the anger and the threat and violence that we're seeing, certainly on American campuses, which is clearly unacceptable. And the fact that the organizations don't really know how to deal with it and how to oppose it within the confines of ensuring that, as we all want in a free society, that there's free speech and the right to demonstrate and the right to express opinions. But it is a narrow path that we've always trodden down in human history to ensure that that's done in the appropriate way. And there's no doubt, looking at the visuals that we've seen in the recent times, that that's veered onto the wrong side of that line. But I don't think that should negate the ability for those people with strong opinions to express their views as to how organizations who they are effectively funding in one form or other invest that capital. It doesn't mean that the organizations have to follow that politicking or boycotting or whatever wish you would. But I think it would be a sad state of affairs if we tried in some form or other to deny the rights of people to express those views, provided they're expressed in the appropriate manner.
I don't think it's a coincidence that we're seeing protests on university campuses now, and we saw them last in 1968 when there was a big transfer of power between the GI generation and the boomers. And now we're seeing the same thing happen between the boomers and the millennials, really, and younger people. And it's just symptomatic of the fact that different cohorts of people, because of their different life experience, think differently and value different things. I think debate is healthy. I think if you're investing your own money, you can choose what you want to do, and that's fine. Of course, most of us invest money on behalf of a multitude of people across different age cohorts and in different areas, and that's when it gets a bit more complex. But I think it's just symptomatic of the fact that the world is getting much more complex, and all of our jobs are much more complex now. And it's a good thing that we're demanding more transparency about what we're exposed to, what we're investing, what those companies are doing. Every organisation will draw its own views about where it wants to go or not. They've all got different contexts, but the conversation's a good one.
And it becomes more complicated the more global we will become with our investing and our counterparties. So I think that the strange thing that's occurring in society at the moment, and particularly in amongst the student cohorts across the world, is the disconnect between the values that they seek to represent and the values they think they are protecting. And that's a difficult situation. But that, again, goes back to education, both in terms, on a broader sense. But I think we would all be of the view that there should be no desire to limit that ability to express those opinions.
Andy, can I just come back to you? So, you very clear that even a younger generation who cares about those the ESG or the other impacts, if they are asked to compromise return, they wouldn't say yes. So they think that's our professional responsibility to navigate. So the question too is is it really a kind of educational process? Because a lot of younger people accept paying higher price for their consumer product when they see that's more environmentally friendly or healthier for themselves. They just accept the higher price. But why they don't accept the higher price for the investment? That's the question to you. And is it a possibility that that could happen? And then after that, I want to ask Saira that given your role as a CIO, you really have to navigate the gap. Even you see that that may be coming into the market, you cannot wait for 2 years or 3 years. You just navigate today's market. So the question to Andy is that whether it's possibly change that, or should we change that, or to after that, Saira, that how you address that the kind of the difference in that.
I think that are there a certain number of disconnects here that you're pointing to? Yes. Yeah. I think the answer to the first question you asked is a little bit in the realm of behavioral finance, where understanding investment returns and kind of comparing a subpar investment return to paying more for a consumer product. I think that most people, even if they had gone through the financial literacy training, they have a hard time comparing those two things to each other. I think in the case of university endowments, and where we're talking about views being expressed that might equate, over the last several years, exiting energy stocks and seeing the endowment underperform, that is quite distant from those who are expressing their views. So I don't think there's an immediacy there. Therefore, I think that, fundamentally, the trade-off is not as clear as it feels here in the panel. I do think that if when we say this, if we made it very clear and said this is going to cost you $1 million of balance in your retirement account 35 years from now, the pushback would be as I described. Hey, do better. There must be a way to get roughly the same return, but be proceeding in ways that are consistent with the way I think about the world. And that's produced already in our industry lots of tools to help customize portfolios and provide overlays that get us closer to that pushback that's coming. So that's my overall take.
Thank you. So, Saira, do you think we can do it?
Sure. No, I thought that was great. I might just approach it more from I'm a day-to-day investor managing a global equity portfolio. So what are markets really thinking about? Well, markets are very fixated right now on whether the Fed will cut rates, what's the timing, what's the magnitude. 2 for the bulls, two for the bears. Payroll data came in weak on Friday, and Q1 GDP missed estimates. Markets were kind of off to the races. This is sort of bad news is good news. It increases the chances of Fed rate cuts. But on the other side, sticky inflation that remains above the Fed's 2% target, significantly above it. And the Fed said they will not cut rates until inflation is at its target. And consumer spending continues, which is very inflationary. That's really what the markets have been trading on recently, year to date. The strength of the economy has been what has been strong for the markets. But you go longer term, and there are these issues ranging from geopolitical issues, which are like black swan events. You just don't know when any of these may bubble up, even the ones that are known to be occurring. We don't know how bad that will get. The U.S. level of debt is at record levels, and now we're looking at periods of interest rates that are much higher than we're used to in terms of servicing that debt. What does that mean for the markets going forward? We've talked about so many other issues today. Where is education going? How do people think about climate change and impact on their portfolios? These are all the longer term things that, it's hard to really hone in on those as investors, especially when, really the markets are, sort of going up and down on the day-to-day. What do we think the Fed will do? What is the next payroll number going to be? Are we going to see the recession that we've been talking about since 2023 that has no signs of coming yet?
Sorry to dig into this point, but Sarah, that when I was running a GPI, I tried to create like a Paris-aligned like investment indices, and which turned out to have the almost intolerable like a tracking error, because the current market has not really those risks into their valuation today. So, how long you think that we can live with that kind of the gap between, if you take a longer term perspective, the price should be different, but the current price is actually not, in the current market is not pricing that way. And then I think Andy is basically saying like even the younger generation believe that's your professional responsibility to navigate. But how long we can live with that kind of gap, and when all the forces coming from the younger generation may change the real market.
I mean, I can just take on the issue around why the longer term perspectives don't get priced in is because there's so much uncertainty around it. We can all sit here today and tell you what we think that the millennials think and Gen X thinks, but really we don't know what they're going to think when all that wealth transfers to them. We can talk about geopolitical issues, but we have no idea really what's going to happen. So it makes it so hard to price in that the market just looks at things they can be more certain about, which is a strong economy, strong earnings, first quarter earnings, 80% of companies beat consensus. And that's why the market tends to be, more focused on this. And, with the long-term stuff, it just sort of sits out there. And we wonder, will the Fed cut rates soon enough so the U.S. record level of debt is not such an issue? But, we just don't know that. So it's hard to price that in. I might even take that to technology stocks. We all know that the Magnificent Seven has basically been driving the markets for over a year now. And they're the other side where there's so much growth in front of them and such strong structural growers that people are willing to pay premiums for these companies because they can see that path ahead and the AI trade and all of that momentum behind these companies, that we're confident paying these premium valuations for them, which some people go, how are you paying that much for these tech companies? Well, look at their structural growth rates.
You know what, I would just build on that and offer maybe one other perspective, because your question, it's a great one, but you're getting down to a pretty finely, it's a pretty fine point. And I think when we get there, we almost have to take a step back and say, hey, is this the most important thing that's happening in terms of this ESG preference? I would argue women as financial decision makers around the world is going to have a far more profound impact on the nature of portfolios that are going to be built worldwide than specific ESG considerations, because you're going to have different mindsets, different perspectives, much closer to household capital allocation decisions than was happening decades ago, and that's it's a tremendously positive thing, and I think it probably swamps what we were talking about earlier.
Just back to your original question, right? So you mentioned tracking error. Right, so maybe a better question is why do we even have that term? Like, what are we here for? We're here to generate long-term wealth for our end constituents. Why do they care which index we're using to compare them against? That's a governance problem in the industry. And maybe we don't need CFAs and people who've studied finance because they're just going to think in tracking error terms. Yeah. We could flip that and say the world has to decarbonise. 100 governments around the world have signed up to that, so it is going to happen. So why don't we start with the Paris-aligned index, which at least now exists, and if you want to go into the market cap index, that's a tracking error, right? So we've got to reframe the question.
Yeah, that's what our industry is not very good at, right? We just kind of stuck to the education we received 30, 40 years ago. Okay, well, I think we have 5 more minutes, and then, well, several questions I try to introduce, but one thing I found interesting is that whether our industry or like the financial, professional should take care of the human well-being. So I think that's another dimension of the younger people are more concerned about the mental health and well-being. Would it affect the capital market we are operating in? Anybody has an opinion?
It has to. I mean, again, there's been a bit of conversation about that here this week. The Australian government, I think last year, published some wellbeing statistics alongside its budget for the first time. The New Zealand and some of the European governments have done that for a while. They got stick from economic commentators, largely conservative ones, to say that's an excuse to not think about economic growth, inflation, budget deficits. My view is I don't think it negates all of those things we know about economics, but it adds another lens because GDP growth doesn't make people happy. In Australia, we've had GDP growth, but we've had negative per capita income growth, which is probably a much bigger impact on whether people are feeling comfortable or happy or not. So I think having a broader mindset about what is sustainable, and I mean that with a little s, not a big S, in terms of how we operate capital markets, how that flows through to real economies, people's actual lives, is much more important. So we can't ignore it.
I think we've all seen a change in attitudes and work desires, certainly since the pandemic, and certainly from younger generations. And clearly, over our lifetimes, the advent of mental health issues, quite rightly, being approached in a much more transparent and honest way than they were in prior generations, is a good thing. Interesting, in the UK, you talked about it, the US, about Australia, but 2 weeks ago, the Prime Minister of Britain determined that he felt that it was getting too easy for people to be signed off for work by their local GPs, and that he should reverse this policy. And he didn't really explain how he was going to do it. It sounded like another quango to get yourself signed off for work rather than your GP doing it because it was too easy, which indicated to me a lack of understanding and reflective behaviour on the unusual world that people have lived through over the course of the last few years. But it is bound to have an impact. I think the desire for work and maybe the stints that we put in as younger in different industries, be it in financial, I grew up in the law, is different to the way that people see their commitments today. And it is interesting when you talk about happy countries, and Australia maybe is not so happy even though it's got GDP growth. If you look at the tables of what makes people happy, and it's not America and the UK and Australia at the top of those lists. Sometimes unusual countries who give people a sense of purpose, who give people a sense of identity, who give people a sense of belonging, which is actually improving people's lives and making people part of it, and is not necessarily just a direct correlation to their financial health.
Yeah, thank you. I think we are running out of time, but the last question I'm really interested in asking myself is that a lot of people who are involved in like ESG or sustainable investments and very concerned about the outcome of a U.S. presidential election, because the people, some people think that will swing the market, but when it comes to the young generations, way of thinking and the way they wanted to use their money in, do you think all these politicization of the sustainable investment agenda will really affect the younger generation thinking? So in other way, do you think the outcome of the U.S. presidential campaign really affect the younger generation, how they will think about their own money?
I mean, I think the outcome of the presidential election is going to have much more of an impact on overall perception of business climate in the U.S. I think that these trends that we're talking about are very durable, and whether the election, regardless of which way the election goes, we're going to have investment decision making charged with this broader set of considerations ongoing, and I think that the reaction that we've seen on both sides of the aisle to ESG topics, it's more messages to CEOs and financial institutions about how to best address these topics that are on the minds of consumers and investors. The political developments aren't going to take this trend away. It's going to continue.
Saira, you have any comment?
I don't have anything to add. Great answer.
I would just say that where you've got an election with two candidates with a combined age north of 160, the notion that sustainability and ESG is going to be at the top of their agenda is unusual, other than their own sustainability. So I think the best thing that we can hope for is an environment whereby maybe next time around we've got aggregate age maybe south of 100. Yeah. And I think that would, as an outsider, maybe serve this country a little better.
Raph, you're happy people?
Well, I'm not a political forecaster, but here's my tip, right? Doesn't matter who's going to win, we're going to get more populist government, more interventionist government, and more inflation.
That's good. Well, thank you very much for all your the active participation of this discussion. I think this panel went autonomous, so I really don't need to moderate, but it's a really great discussion. I hope everybody enjoyed. So thank you very much.
Thank you.